Ma'am, there appears to be a hold on your account. 7 words. That is all it took for a retired school teacher named Eleanor Whitfield to realize something was wrong. She was 69 years old. She had walked into the same neighborhood bank she had trusted for decades, planning to withdraw $200 for groceries and a birthday card for her grandson. She had not bounced a check. She had not missed a tax payment. She had not been accused of a crime. But the teller looked at her screen, lowered her voice, and said those 7 words. Eleanor did not get the $200. She did not get the groceries. She walked back to her car, sat behind the wheel, and stared through the windshield, trying to understand how money she has saved honestly for nearly 50 years could suddenly feel out of reach. And before you think this is just a story about one woman at one bank, listen carefully, because this is where many retirees make a dangerous mistake. They assume that if they are honest, quiet, and careful, nothing can happen to them. They assume banks only freeze accounts when someone has done something obviously wrong. They assume the rules are simple. But in today's financial system, it is not always about whether you did something wrong. Sometimes it is about whether your account activity looks unusual, whether your deposits break your normal pattern, whether cash moves in a way that triggers a compliance review, or whether a legitimate transaction looks suspicious to a system that does not know your life story. That is the part every senior needs to understand. A bank account is not just a place where money sits anymore. It is also a record of patterns. Your income comes in, your bills go out, your balance rises and falls. Over time, that creates a financial routine. When something happens outside that routine, even something completely legal, it can raise questions. A large inheritance check, proceeds from selling a car, a retroactive benefit payment, money from a home sale, a settlement, a gift from family, a series of cash deposits. None of those things automatically mean you did anything wrong, but they can create delays, questions, holds, or paperwork at the exact moment you need your money most. So the real question is not, how much money am I allowed to keep in checking? The better question is, what kind of activity makes my account look unusual, and how do I protect myself before there is a problem? Because there is no magic number that makes everyone safe. A $12,000 balance may be normal for one person and unusual for another. A $9,000 deposit may be easy to explain with paperwork, or it may create confusion if you have no record of where it came from. The danger is not just the amount. The danger is the combination of amount, timing, pattern, and missing documentation. The first mistake retirees make is using a checking account like a storage locker for life savings. Checking accounts are designed for money that moves. Social Security comes in, pension income comes in, utilities, insurance, groceries, prescriptions, rent, mortgage payments, and credit cards go out. That is what checking does best. But when a checking account starts holding months or years of savings, it creates 2 problems. First, that money may not be earning much. Second, if that one account is ever delayed, restricted, compromised, or under review, your entire financial life can get stuck behind one locked door. Think about that for a moment. If every dollar you rely on is sitting in one checking account, then one problem with that account becomes 10 problems at once. You cannot buy groceries, you cannot pay the pharmacy, you cannot cover a repair, you cannot easily move money elsewhere. You may still see the balance on the screen, but seeing money and being able to use money are not always the same thing. That is why smart retirees do not just ask, how much do I have? They ask, how accessible is my money if something goes wrong? The second mistake is making deposits or withdrawals in a way that looks like you are trying to avoid reporting rules. This is one of the most misunderstood areas in personal banking. Many people have heard something about $10,000 in cash transactions, and then they make the worst possible decision. They think, well, I will just split it up. They deposit $3,000 today, $3,000 tomorrow, and $3,000 next week. Or they withdraw several smaller amounts because they do not want paperwork. That can create more trouble, not less. Deliberately splitting cash transactions to avoid reporting requirements is called structuring, and it can be treated very seriously. The safer approach is simple. Do not play games with a number. If you have a legitimate reason to deposit or withdraw cash, be direct, be honest, and keep records. Here is the sentence every retiree should remember. Transparency protects you. Patterns that look hidden can hurt you. If you sold a car for cash, keep the bill of sale. If you received money from a family member, keep a note showing what it was for. If you closed an old account and moved the funds, keep the statement. If you received an insurance payment, keep the letter. If you were paid back for a loan, keep the message or agreement. Most problems become easier to resolve when you can quickly show where the money came from and why it belongs to you. The third mistake is ignoring large one-time deposits because the money is legitimate. This is where many honest seniors get caught off guard. They receive a check and think, "This is mine, so there is nothing to worry about." And morally, they are right. But administratively, the bank may still ask questions. A widow sells her late husband's truck and deposits the money. A retired couple downsizes and receives proceeds from a home sale. A grandmother receives a settlement check after a medical billing dispute. A retiree receives back pay, a pension adjustment, or a tax refund larger than usual. These are ordinary life events, but they are not ordinary account patterns. That is why documentation matters before the question is asked. Do not wait until you are stressed, angry, and standing at the counter trying to remember details. Create a simple folder. It can be paper, digital, or both. Put proof of large deposits in it. Put letters, settlement statements, sale records, closing documents, insurance explanations, benefit notices, and transfer confirmations there. You are not doing this because you are guilty. You are doing it because you are organized. There is a big difference between saying, "I think that was from something I sold a few months ago," and saying, "Here is the document showing exactly where that deposit came from." The fourth mistake is sharing accounts too casually. Many seniors add an adult child to an account after a spouse dies or after managing bills becomes stressful. Sometimes that is helpful. Sometimes it is necessary. But a joint account can also create confusion because activity from either person can affect the account. If your child uses the same account for unusual transfers, online platforms, business payments, cryptocurrency activity, gambling apps, foreign wires, or frequent cash movement, the bank may not separate their activity from yours in the way you expect. To the bank, the account is the account. This does not mean you should never let a trusted family member help you. It means the setup matters. A power of attorney may be better than joint ownership in some situations. A separate bill-paying account may be better than giving someone access to your main savings. A trusted contact on file may help the bank reach someone if fraud is suspected without giving that person control over the money. These are not one-size-fits-all decisions, and they are worth discussing with a qualified professional before there is an emergency. The fifth mistake is leaving automatic payments vulnerable. Retirees often depend on automatic deductions for insurance, utilities, credit cards, phone bills, and medical coverage. Automatic payments are convenient until one account problem causes a chain reaction. A hold, a fraud alert, a closed card, a delayed deposit, or a mistaken transfer can cause payments to fail. Then late notices arrive, fees appear, coverage can be threatened, and the retiree may not realize what happened until weeks later. That is why every senior should know which bills are paid automatically, from which account, and on what date. Write them down. Keep the list somewhere you can find it. Include Medicare-related premiums, supplemental insurance, prescription drug coverage, utilities, mortgage or rent, long-term care insurance, life insurance, and credit cards. Then set a simple rule. If your bank account is ever frozen, restricted, hacked, or under review, your first call is not just to the bank. You also check every essential bill that might fail during the disruption. Now let's talk about the amount to keep in checking. For many retirees, a practical target is enough to cover about 1 month of essential expenses, plus a modest cushion for surprises. That might be $3,000 for one person, $7,000 for another, or more for someone with higher monthly bills. The point is not the exact number. The point is that checking should hold operating money, not your entire financial safety net. Longer-term savings can often be kept in a separate savings account, money market account, treasury account, or another insured institution, depending on your needs and risk tolerance. Using more than one institution can also reduce single-point failure. Imagine having your checking account at one bank and your emergency savings at another. If one account is temporarily unavailable, you are not completely trapped. You still have a way to buy food, pay for medicine, and handle transportation while the issue gets resolved. That is not paranoia. That is basic financial resilience. Here is what I would do this week if I were retired and wanted to reduce risk. First, I would look at the last 6 months of checking activity, not the balance in my head, the real statements. I would circle any deposit or withdrawal that was much larger than normal. Then I would find the paperwork behind each one. Second, I would make a list of every automatic payment connected to the account. Third, I would move excess savings out of checking if the balance is far above what I need for monthly bills. Fourth, I would stop splitting large cash transactions into smaller pieces just to avoid attention. Fifth, I would talk to a tax preparer or financial professional before moving large sums, receiving major gifts, paying household workers, or mixing family members into my account. And please hear this clearly. The goal is not to hide money. The goal is to make your money easy to explain, easy to access, and hard to disrupt. Hiding creates risk. Sloppy records create risk. Mixing everyone's money together creates risk. Depending on one account creates risk. Clean records, clear accounts, honest explanations, and backup access create protection. There is one more warning, and it may be the most important one in this entire video. Scammers know seniors are worried about frozen accounts, taxes, Medicare, Social Security, and bank reviews. They use that fear. They call pretending to be from the IRS, Medicare, Social Security, your bank, or a fraud department. They say your account has been flagged. They say your benefits are in danger. They say you must act immediately. They ask for codes, passwords, gift cards, wire transfers, cryptocurrency, or remote access to your computer. The moment someone creates panic and demands secrecy or immediate payment, stop. Do not argue. Do not explain. Do not press buttons. Hang up. Then call the official number from your bank card, your statement, or the agency's official website. Never trust the number a caller gives you. Never click a link in a text message about your bank account. Never give a verification code to someone who called you. A real institution can wait while you verify. A scammer cannot. Eleanor Whitfield is not just one woman. She represents the retiree who did everything right but kept too much money in one place. She represents the widow who deposited a legitimate check but had no paperwork ready. She represents the grandfather who split cash deposits because he thought he was being careful. She represents the senior who added a child to an account without understanding the consequences. She represents anyone who believes that honesty alone is a financial protection plan. Honesty matters. But in today's banking world, honesty needs organization beside it. Keep records, keep accounts clean, keep emergency money accessible, keep automatic payments tracked, keep family help structured properly, and keep your guard up when anyone calls trying to scare you. Tonight, do one simple thing. Open your checking account and look at the real balance. Then ask yourself 3 questions. Is this account holding more money than I need for regular bills? Can I explain every large deposit from the last 6 months? If this account were unavailable tomorrow, how would I buy groceries and pay for prescriptions? If those questions make you uncomfortable, that is not a reason to panic. It is a reason to prepare. Because the worst time to build a backup plan is after the bank says there appears to be a hold on your account. The best time is before anything happens, while your money is still moving normally. Your records are still easy to gather, and your choices are still fully in your hands.